All right, everyone, let's get started. Today, we're going to dive deep into one of the most powerful and, frankly, most misunderstood tools for building wealth in Canada. I'm talking, of course, about the Tax-Free Savings Account, or TSFA.
This explainer was prepared by Samir Al-Rashani, PhD, with AI support.
So let's just start with a simple, almost unbelievable question. How can you make your investments grow? We're talking interest, dividends, capital gains, the whole shebang, and have it be completely 100% tax-free. I mean, a world where the CRA doesn't get a single penny of your profits? Well, it's not a fantasy. That is the core promise of the TFSA.
Okay, so here's our game plan for today. First up, we'll unpack that amazing tax-free promise. Then, we'll get into the nitty-gritty of how it all works, the mechanics, and the rules. Next, and this is a big one, we'll look at the fine print, the pitfalls you absolutely need to avoid. After that, we'll put the TFSA head-to-head with the RRSP. And finally, we'll talk strategy, so you can figure out how this all applies to you.
All right, let's jump right into Section 1, the tax-free promise. We need to get crystal clear on what makes this account such a game changer. So here's the official definition. It's simple, but man, is it powerful. Inside a TFSA, all your investment income is tax-free. Full stop. It's not taxed while it's growing, and it's not taxed when you pull it out. This is the absolute key difference you have to remember. This is permanent tax-free growth, which is a totally different beast from the tax-deferred growth you see in an RRSP.
Okay, Section 2. Let's talk mechanics. Now that we know what it is, let's get into how it all actually works. We're going to cover the real nuts and bolts here: contributions, growth, and withdrawals.
This slide, right here, is basically the TFSA's DNA. Let's walk through it. First, your contributions are made with after-tax money, which means you don't get an immediate tax deduction. But, and this is the big trade-off, once that money is in, every penny it earns is yours, tax-free. Plus, you have total flexibility. You can pull money out anytime for any reason with no tax hit. And what's really cool is that any contribution room you don't use just rolls over, forever. And finally, unlike an RRSP, the limit is the same for everybody, whether you make $10,000 a year or $10 million.
Speaking of that limit, for 2025, it's $7,000, same as it was in 2024. But you gotta remember, this number isn't set in stone. It started way back at $5,000 in 2009, and it's indexed to inflation, which is why you see it pop up in these $500 chunks every few years.
And this slide really shows you the power of that carry-forward rule. I mean, think about it. If you turned 18 back in 2009 and never put a single dime into a TFSA, your room has just been quietly piling up year after year. By 2021, for example, your total available room would have been $75,500. It's just waiting for you.
Now this is one of the TFSA's absolute superpowers. It's the recontribution rule. Let's say you take out $10,000 this year. Okay, that withdrawal is tax-free, we know that. But here's the magic trick. On January 1st of next year, that exact $10,000 space is added right back to your contribution room. This makes the TFSA an unbelievably flexible tool for big life goals, like a down payment, because you can use the money and then put it back later without losing that precious space forever. So, what can you actually hold inside a TFSA? This is so important, class. Please, don't let the name savings account fool you. It's a terrible name. It really functions as an investment account. You can hold almost anything in there. Stocks, bonds, ETFs, GICs. Pretty much the same lineup of qualified investments you can hold in an RRSP.
All right, let's move on to Section 3, the fine print. And I need everyone to really lean in for this part, because ignoring these rules can get you into some serious and very expensive trouble. The number one trap, the mistake people make all the time, is over-contributing. If you put in even $1 more than your limit, the CRA slaps you with the penalty tax of 1% per month on the extra amount. Let me say that again so it sinks in. Per month. That's a punishing 12% annual penalty. You have got to track your contribution room like a hawk. And now for a court case that every single one of you in this taxation course needs to have burned into your memory. An investor was day trading like crazy inside their TFSA. The tax court looked at the sheer volume and frequency of the trades and ruled that it wasn't investing anymore. It was carrying on a business. The result? absolutely catastrophic. The account's tax-free shield was completely vaporized, and all of that incredible growth from 15 grand to over 600 grand became fully taxable income. The lesson here is loud and clear. A TFSA is a tool for investing, not for running a day trading operation.
This all leads us to the classic Canadian financial cage match, Section 4, TFSA versus RRSP. As future tax professionals, you are going to get this question 1,000 times. So let's break down how to choose the right tool for the job.
At its most basic level, the difference is all about timing. It's about when you pay your taxes. Think of it this way. With a TFSA, you're saying, I'll pay the tax now on the money I earn. You contribute with after-tax dollars, and then everything from that point on is tax-free. And RRSP is the opposite. You're saying, I'll deal with the tax later. You get a tax break now, but you have to pay tax on everything when you take it out down the road. Now, this table is fascinating because it reveals a surprising mathematical truth. Let's just assume your tax rate is 40%, both now and when you retire. Okay, follow the TFSA column. You earn $1,000, pay $400 in tax, and invest the $600 that's left. 20 years later, it grows to $1,924. You take it out, tax-free. Now look at the RSP. You invest the full $1,000, and it grows to over $3,200. But when you withdraw it, you owe over $1,200 in taxes. And what's the net result? Look at that, $1,924, the exact same amount. This is the key insight. If your tax rate stays the same, the math works out identically. So that begs the obvious question, right? If the math can spit out the exact same number, then how on earth do you decide which one to use? What's the tiebreaker?
And that, my friends, is what our final section is all about, strategic choices. This is where we stop talking theory and start talking about your actual plan.
The tiebreaker is almost always your tax bracket. You should lean heavily towards the TFSA if you're in a lower tax bracket now than you expect to be in the future, which, let's be honest, applies to most of you as students. It just doesn't make sense to take a small tax deduction today when your income is low, right? You're better off paying the tax now and enjoying tax-free growth later when you're in a higher bracket. Plus, that flexibility for withdrawals is huge, and it's the perfect spot for money that's already tax-free, like an inheritance.
On the flip side, the RSSB becomes your best friend as your income climbs. When you're in your peak earning years, that immediate tax deduction is incredibly valuable. The whole strategy is to defer taxes from your high-income years to your lower-income retirement years. That difference in your tax rate is where you find your savings.
But of course, in the real world, it's not always a battle to the death between these two accounts. As our source material wisely points out, if a person can afford it, both plans should be used. And it's true. They work together, serving different purposes in a smart financial plan.
So, to wrap it all up, the TFSA is just this incredibly flexible and valuable machine for building wealth. If you take one thing away from our class today, let it be the sheer power of its defining feature: permanent, compounding, tax-free growth.
And so I'll leave you with this final strategic question, one you'll face for the rest of your financial lives. How are you going to balance the short-term sugar rush of an immediate tax deduction against the long-term flexible power of completely tax-free growth? The right answer for you will change as your life and career evolve, but learning how to answer it, well, that's a cornerstone of financial success in Canada.